Welcome to the Morris Financial Concepts Podcast. I'm your host, Richie Guerzon, and today we're talking to Bart Valley about the debt ceiling. Bart, how are you doing?
Doing great, Richie. Thanks again for having me. Good to be back with you.
Well, we have a very interesting timing on this show today. So, what's the current status of the debt ceiling?
Yes, absolutely. Fortuitous timing. So we've reached a resolution, right? It's been in the
Yeah.
news a lot lately, center of a lot of concern, obviously, but we've reached an agreement in principle to suspend the debt limit through January 1st of 2025. So the House and the Senate have both passed the debt bill with bipartisan support. Certainly some opposition on both sides, but
Always is.
majority, majority support in both houses. And so that's on its way to the president's desk, and we'll be there soon. And so, as with any deal, both parties got a little bit of what they wanted. Both parties accepted a little bit of what they didn't want, but that's good. That's how compromise works. And just a couple of specifics. I haven't memorized all this yet, but the bill obviously addresses the debt ceiling, like I said, by suspending the debt ceiling. So it didn't raise the debt ceiling, but suspended it through January 1st, 2025. So we're good at least until that point. So also as part of this agreement, we're capping non-defense spending. Relatively flat levels for 2024, and then I think a 1% increase in 2025 on non-defense spending.
All non defense spending?
Yeah, I don't know the details yet there, but in aggregate, I think there's around a 1% cap there. But yes, capping non-defense spending.
Okay.
Also protecting some things, protecting veterans care, protecting some of the climate and clean energy measures that were put in place through the Inflation Reduction Act. It also expands work requirements a bit for some of the public assistance programs, specifically some of the nutrition assistance programs, and it's the age requirements that are being expanded for work requirements there. Getting back some of the COVID-19 relief funds that weren't spent, cutting some of the Internal Revenue Service funding, and finally restarting student loan repayments. So those are kind of the backbones. So again, both parties got some things they wanted. Both parties accepted some things they didn't want.
Mm.
I don't think anybody would say this is a perfect solution by any means, but it's certainly better than the alternative, which would have been a government default, which we were closely approaching that time.
Yeah. All right. So, I'm not understanding what the suspension means as opposed to raising the ceiling. I'm thinking of it in terms of my personal credit card. How does this
Yeah,
relate?
exactly. So, and we'll talk a little bit more about what the debt ceiling is exactly in a minute. We can do that, but
Yeah.
basically, there comes times when that debt ceiling, which is just a certain number, it's basically the debt ceiling is the total amount of money that the U.S. is authorized to borrow by Congress to
Yes.
meet existing obligations. So things we've already agreed to pay for.
Mm.
And we'll talk about, because it gets kind of confusing. What's the difference between deficits and the debt ceiling? But the debt ceiling, exactly, Richie, that's a good analogy, is like that credit card limit for the country. So when we start to bump up against that credit card limit, we can address that in one of two ways. We can temporarily suspend that credit card limit and say, don't worry about the limit for a couple of years. We'll deal with it a little bit further down the line. Or we can increase that credit card limit. In this case, at this point, it's been a suspension of the debt limit itself.
Meaning you can just go beyond debt limit. It
Exactly.
doesn't make any difference.
Exactly. So
Oh,
we'll talk a little bit about how meaningful the debt limit is,
yes.
and are there other options?
Well, then let's go back and explain the difference between the debt limit and the deficit and all of that, because that
Yeah,
is confusing for sure.
it is confusing for most folks. So the deficit. So for the most part, in most years, this country, we spend more money than we take in. And that's called a budget deficit. And
Mm.
especially since the 1980s, we've been running pretty significant deficits, and those vary from year to year, but they've been pretty consistent with the exception of the late 90s and early 2000s when we ran surpluses for a couple of years. Most other years since the 80s, we've run pretty significant deficits. The debt, or the total national debt, is just the accumulation of those deficits. So if we're running a certain deficit each year, those start to add up over time, which cumulatively equals the national debt, which currently stands at a little over $31 trillion. And that's where we got into this problem where we started to bump up against the debt ceiling, which I explained is the kind of maximum allowed amount. And so
is this a per year thing, or is it a total, how does that work?
So the deficit, again, it's kind of confusing, right? So the deficit is per year, but as the deficits add up and accumulate into that overall national debt, that will grow over time, right? Until it bumps into that debt ceiling. And then when we start to bump into that debt ceiling, that's when something needs to be addressed.
So the debt ceiling is how much that we're allowed to accumulate every year
in total.
Okay, sure.
So yeah, the debt ceiling is a total figure. So that's a cumulative total. It may be over a period of whatever years.
Okay.
And so another thing that's important, I think, that can be confusing, and I'll point out, is that the debt ceiling, that doesn't increase spending. So if we suspend the debt ceiling or we increase the debt ceiling, that has nothing to do with what kind of spending is authorized. The debt ceiling is just allowing us to pay for purchases and obligations that we've already made.
That part is confusing.
Yeah, so we can talk about budgets, and that's a kind of a different process, right? But if we feel like we're spending too much money, that's addressed in a different direction than the debt ceiling. The debt ceiling is not an authorization of new spending. It's just saying, hey, we agreed to certain spending. We're not having the revenue coming in to meet what those spending agreements were. So we're having to borrow money to meet those obligations. Are we going to allow ourselves to increase that limit to pay for those obligations we've already made?
But I mean, is it true to say that if we did in fact not raise the debt ceiling, that it would have the effect of reducing spending because you'd have to? Is that true?
Yeah, but that would be a very harsh way to do it. So again, I think this way to address spending is through, what are our programs. We'll talk a little bit more. There's a couple of ways to address the debt. And that's a complicated political space, but we'll talk in a few minutes about maybe, how we can do that looking forward. But I don't think we'd want to test that by hitting the debt ceiling and getting truly to what's called a debt bind, where we run out of money.
I see.
Yeah. What would the consequences be there? We don't know. It's never happened before. And again, this can be, maybe we'll spend just a minute because this can be a little bit confusing too, because I think in the news, people might hear, oh, we've never reached the debt ceiling before. We've never had that kind of a government shutdown. Wait a minute, I thought we did have government shutdowns before.
Yeah, I recall that.
Yeah, absolutely. We've had government shutdowns, but those have been through a slightly different mechanism. So look at it like this. The easiest way to think about it, that spending that we do every year, the spending that the government does, about 2/3 of that is what's called mandatory spending. That's things like Medicare and Medicaid, Social Security, interest on Treasury notes, some assistance programs. Those are all, none of those are subject to annual approval in the budgeting process. Those are revisited every now and then, but they're not subject to annual approval. About 25% of the budget is what's called discretionary spending. And there's 12 different areas of government that are subject to what are called appropriations bills. So those areas are things like, science and technology, transportation, education, defense, certain other assistance programs, where every year Congress has to say, do we or do we not approve this budget for each of those 12 areas?
Mm.
So when we've had government shutdowns in the past, it's been through that appropriations process. So just that 25% of the overall federal budget is affected. And so we've had periods where we've had shutdowns for a day or two, some for several days, but they've only affected certain parts of government spending. If we ever reach the debt limit, that basically affects all government spending. So we get to a point where the government runs out of money, and then it has to start picking and choosing, what do I want to pay for and what do I not, because I don't have the money to pay for everything. So that would,
Well, it kind of shows you how powerful of a tactic you're basically holding everyone hostage. And
yeah, and I think it gets frustrating, again, because the debt ceiling too often, I think, gets used for political leverage.
yes.
Again, this happens on both sides. The debt ceiling. We can talk in a minute a little bit more about the history of the debt ceiling, but it's been raised 78 times since 1960, according to the Treasury Department. So it happens a lot, and it's been raised under both parties being in control of Congress, both parties being president. But again, it's also been held hostage, or used as a political leverage tool, I think, too often, and especially more recently, towards, getting some other changes in some of these appropriations bills. So, it's a the what would happen if we got to that point. Again, we don't know, because that truly is unprecedented. So
I see.
again, I'm glad we got to an agreement this time, and didn't have to find out those answers.
Bart, can you share any historical events related to the debt ceiling?
Yeah. So the debt ceiling, just a little bit of history. It came about via legislation during World War One, I believe in 1917. Don't you can fact check me on that, but sometime in the 19 teens, we'll say. So it's
Okay.
been around for a while, and as I said, according to the Treasury Department, since 1960, debt ceiling's been raised a total of 78 times. Most recently 2014, 15, 17, 2019, and then the most recent time was in 2021, under both parties again. As
So it's
far,
not understood that it's every year we're raising a debt ceiling. That's not how it
yeah,
works.
not necessarily. A lot of times we'll try to, hopefully, I think we probably do this more often than we want, but I think the intent is, when that limit is raised, or when it's temporarily suspended, the intent is, like, let's get down the road further than 6 months, right? Let's go a couple of years down the road,
Mhm.
readdress some of these issues, but not have this coming up every, 3, 4, 5, 6 months, where it's causing market volatility and other concerns, so we can do more important work. So yeah, it's typically every couple of years, every few years, that this issue comes up. This was a relatively close call, again, as far as the timing, and how close we got to the Treasury's estimate of when we would run out of money in the Treasury Department.
Mm.
The last time this happened was in 2011, that we got this close.
Oh,
And
was it that long ago? It seems
yeah,
closer. Okay.
so it's come up certainly since then, but 2011 was the last time where we said, okay, we're kind of close to this actually happening. We're,
Mm.
we're, we're toying with that. And what happened in 2011? It was, again, a kind of a last minute fix there, and an agreement. But what happened subsequent to the agreement, actually, in 2011, is S&P, which is one of the rating agencies for bonds, says, they put ratings on bonds to say how safe they are, basically. They came in and said, hey, we're going to take U.S. Treasury notes from the highest rating, and we're going to knock you down a notch. So that was the first time that it ever happened in 70 years, that the
I know,
U.S.
especially for the United States, that seems like
Yeah,
unheard of.
yeah, and so yeah, it was unheard of, and it certainly affected markets negatively. The markets were down significantly after that, even though a deal had been reached on the debt ceiling. That downgrade had a negative impact. Markets were down pretty significantly. That all happened in October timeframe, and markets were back by early the next year, but certainly caused negative impact when it happened. So that's a little history on the debt ceiling.
All right. Well, so what factors contribute to the need to even raise it in the first place?
Yeah, so it's pretty straightforward here, right? It's again that growing debt. And so as we said, most years the government is spending more money than it's taking in. And that was exacerbated really, Richie. Well, the debt itself, that accumulation of debt was exacerbated more recently by a couple of pretty significant events. So that was the financial crisis in 2008,
Mhm.
and then certainly COVID in 2020. Both of those are things that took significant levels of government spending to help us out of. And that's important. The government's got a role there in preventing severe economic downturns. And so deficits are not necessarily a bad thing.
Yeah.
And sometimes they're certainly a necessary thing. But again, at the current debt level, let's round it off to 31.5 trillion. I think a little bit over. I think we're at 31.8 trillion right now. I don't
Are
know
we?
the exact number, but between 31 and 32 trillion in debt. And we can talk in a few minutes like how much debt is sustainable, is reasonable. There's not an answer there, a definitive answer. Certainly a lot of different opinions on that. But I think the other factor that we have to think about with debt and deficits is now, there's interest payments on that debt. So the debt we've accumulated, that's in the form of borrowing. The government has sold treasury notes and then gets money for those treasury notes and pays interest on those treasury notes.
Yes.
For the past 10 years, that interest has basically been zero. So it hasn't hurt to borrow.
That's what I was just gonna ask. Did
Yeah,
our own action of raising the interest rate so aggressively cause this to be more difficult to pay back?
yeah, Richie, that's a great point. All these things are interconnected, right?
Yeah.
Sometimes we look for binary answers to problems that are so complex and so interconnected. So I appreciate you pointing that out. But yes, you might be fighting one thing and cause other types of problems. But yeah, so the interest service on the debt is going up significantly as interest rates are higher. So now we've got a high level of debt and an increasing debt service level. So, I think it's at the point where we got to think about what does the future look like and what are some potential solutions to, make some changes there that might be appropriate.
Well, so what can the government do to address the underlying causes of the debt ceiling problem?
Yeah, so you might get me into trouble here, Richie, because this is an area where we start to get into politics.
Ah, yes.
And I try to stay, when we're working with clients, we have clients across the political spectrum.
I'm sure.
And so I try to stay pretty apolitical in respect to, investment work I'm doing with clients. But, I think understanding these issues is important. And there are certain facts, right, that we can talk about that are outside of opinions that one might have from a political nature. But we got to understand here the issue is the accumulating debt, right? And there's two solutions to that. We either bring in more money, so that's in the form of tax increases or tax reform, or we spend less. We get a better handle on our spending. We have things we can do. Again, we ran surpluses in the late 90s and early 2000s, so it's not an impossibility. We can get
Yes.
there. We have here's what I'll say without being political. We do have space as a country to pay more taxes. We do have space as a country to reform spending programs. But
Okay, I see.
yeah, but the political space is very, very complicated. And sometimes
Yes, of
I think
course.
we all know it seems like the last many years we've probably become a little more entrenched and intractable. It seems like sometimes on the political front, but these are not intractable problems. We have solutions. It just takes political will.
So when you say raise more money, are you solely talking about taxes? Is that, or because
Yeah,
what comes to my mind is, I don't know if this is related, but I assume it must be. If GDP increases substantially because of AI and robotics and whatever, does how much does that affect this whole equation?
Richie, that's great. So yeah, the easy answer is it's to increase money coming in through taxes or decrease money going out through spending.
Yeah.
The other way to look at debt is not the absolute level of debt, but debt as a percentage of GDP. And that kind of gets to where you're going there. So, again, the debt at a pure dollar level is way higher than it was in 1920. That makes sense, right? Inflation, things cost more.
Yeah,
It's
of
always going to be
course.
growing from a dollar standpoint. So an important way to look at debt is what is the overall debt as a percentage of GDP or the
Mm,
total value of goods and services that we're producing in the country. Right now, we're north of 100% in that ratio. We've been there before. During World War II, we were at 100% or slightly north thereof. But
sure.
we're higher than we've been in a while. And again, the interest service is picking up. But going back to what you were asking about GDP, if you look at debt over GDP, the other answer to bring that down is to raise GDP. And so, yes, if we're promoting programs, or even if part of that deficit spending is going towards programs that are potentially increasing GDP, increasing productivity, enhancing technology for the future, that can be
Yes.
another way to help with the debt. Absolutely.
Okay. I'm just wanted to make sure I was thinking about this
No,
correctly, because as
you're
a small
thinking about it
business
correctly.
person, to me, the answer is bring more value,
Yeah.
and it will kind of
Um,
solve the other things. But I know it's not that simple. Okay.
yeah, and that's not going to be the only solution. At some point, if we want to bring deficits down, and if we want to bring the overall debt down, whether you're looking at it in absolute terms or as a percentage, we're going to need to address either taxes or spending or both as well at some level. But yes, if we're increasing GDP, that's certainly helpful.
All right. So, what are some of the risks associated with raising the debt ceiling?
Well, I think the risks are kind of some of what we've been talking about. It's are we allowing more debt, permitting more debt? Are we promoting less fiscal responsibility? Um, and so again, how much is too much? And there's not an easy answer there. We're at, if you look at that debt to GDP ratio, we're a little over 100. People might say that's high. Japan has been around 200 or higher for a long time, and they're doing okay, right? And they're
Japan, I
making,
didn't. Japan is. I knew they had a problem with 200 or higher.
yeah, and it's not necessarily a problem. It depends on the country and the
Yeah.
nuances of what they're doing. China right now is approaching 300. So again,
What?
yeah,
Okay.
it's and so we're not like the world's leader here. But it's how much is too much and what's right for our country. And again, it's not an easy answer there. Look, I think a lot of people, one of the easy answers is say, hey, let's have a balanced budget amendment, and let's balance our budget every year. Families have to balance their budget. Why can't the government balance their budget? Well, families don't have to pay for COVID responses. Families don't have to pay for wars. Families don't have to pay to fix the interstate back
Mhm.
behind their house. So again, it's not reasonable to balance the budget every year. Again, sometimes deficits are okay, and sometimes deficits are needed. But again, just continuing to run up that debt without a plan, right, is probably not the best answer for the long-term financial health of the country.
Well, that's fair. All
Yeah.
right. So, can we talk a little bit about the political dynamics when we're talking about the debt ceiling negotiations, just in general? How is it? How are political dynamics affecting these negotiations?
Yeah, and again, it's a complicated political space, and so it's a part of all these negotiations. Uh, Especially again as we see maybe political sides getting more entrenched, and that's one of the things that was a concern, leading up to this debt crisis, because it's easy to say, hey, this is not an issue. It's always been raised in the past. We always talk about it a lot, and then it always happens. Yes, Fortunately, that's what happened this time. But, we could get to a point where there's enough members of Congress that are willing to say, hey, you know what? I'm tired of the way things have been going. I'm willing to blow something up just to see what happens, and then we'll rebuild from there.
Uh,
I don't think that's the answer, but it's reasonable to expect it at some point. We might get there, and so again, I think it's important that we address some of these things on an ongoing basis rather than getting into crisis mode and coming up to, well, if we don't do something in the next week or so, we'll see what happens. I don't think that's
it's
where
definitely not the most professional thing to do, just
yeah,
procrastinate or wait till the last possible
absolutely.
minute. That was
Um,
generally looked down upon in my schooling and professional career.
yeah, absolutely. I think all around. But again, the political piece is, we've got to realize that this is not something that has it's gray areas, right? There's no right or wrong answers. There's no binary solutions. So these are complicated problems that will take, really thoughtful solutions and nuanced solutions, which again are going to require, by their nature, compromise and work together. So I hope we can continue to do that.
Yeah, absolutely.
Yeah.
All right. So how does debt ceiling relate to fiscal responsibility, government accountability? How are they connected?
Yeah, I mean, I think that was the original intent, going back to the 1917 law. It was to promote that fiscal responsibility. Again, just like a credit card that you or I might have, we've got a credit limit on that, right? Based on our financial history. And part of the intent there is to keep us from getting in too much trouble. So we bump up against our credit limit, and credit card company says, well, figure something out, right? That was the intent with the debt limit as well. Now, again, how much that's actually worked is up for debate. I would hope that on occasion it causes us to re-examine what we're doing. But if you're just continuing to increase the debt ceiling, I think again we've got things here that need to be addressed, especially as we get to this point where, like, we don't have free money anymore. We're paying higher interest on the debt. And so, I think that part of, like, how much of future growth are we trading for current spending, and what type of current spending is that? Again, like, every country is going to have a different answer as to what's right for them. But I think it's something we have to address more seriously.
Oh, that's fair. Well, so how do financial advisors work with their clients and kind of work with the risks associated to these negotiations in these times?
Yeah, that's a great question. And certainly we saw it all over the news. And again, I don't know what the outcome would have been had we reached the debt ceiling, but you hear, Armageddon, catastrophe, and all those words that are on the news every day. So it makes us kind of scared, right? What are we doing? We being investors, and what should we be doing? And so this is one of those things that's not that different than, like, a COVID or other things where there's some, it's a little bit scary in the short term, and there's typically some market volatility until we get some answers, because markets don't like uncertainty. But here's the thing. These things, it's really difficult to predict the outcome.
Yeah.
It's even more difficult to predict the timing of the outcome. Take that up another level, it's even more difficult to predict the market's response to that outcome and the timing of the market's response to that outcome. So,
okay.
right, you got to be a lot on a right of guess. You got to be right on a lot of guessing to be able to make investing decisions based on these short-term question marks, regardless of their nature. So again, it's one of those things where we want to invest based on established goals, on an appropriate mix of safety and growth for each client, and know that uncertainty is part of that. There's always going to be something to worry about. Uncertainty is part of it, but being okay with that. And so the short answer is, we don't want to make investment decisions based on these short-term market phenomena.
Yes, this feels like a running theme as we talk. Like
Yeah,
all these things are happening in the world, but
yeah,
the answer is generally the same.
yeah,
Look at it
absolutely.
from a long-term point of view.
Yeah, and
Let your
and
emotions
again, most
drive.
importantly, be proactive in your planning.
Mhm.
Again, develop a mix of assets and a portfolio mix that is the appropriate mix of growth-oriented investments and safety-oriented investments for you. Develop a risk tolerance that you're comfortable with, and embrace uncertainty because it's going to be there. But it shouldn't change. Again, you want to be proactive and not reactive in your investment approach.
Oh, that makes sense. Um, what do you think the public sentiment and media coverage are affecting these negotiations one way or the other?
Yeah, and that's tough. I don't know what goes on up there in Congress.
Mm.
I would like to hope that politicians are still somewhat responsive to sentiment. And I think
Yeah,
overwhelmingly,
right?
yeah, I
They
would
are
hope that's the
they are
case.
their constituents, right?
Yes, I would hope that's the case. So, and I think overwhelmingly the country wanted this to be done, wanted to put this behind us. Again, regardless of your political slant, this is not the way, that I think any of us want to address these issues, is through last minute crises. And so I think overwhelmingly people wanted to get this debt ceiling agreement done, put this behind us and move on and address this in different ways. So hopefully, that had an impact on what the politicians were doing. And again, I look at it as a positive that we came together. We had, both Democratic and Republican support in both houses to get this done. And that was important. And it was compromises. Um, as far as the media goes, that was the other piece of that question. As always, I think the media is important in being able to stay informed to the level that you want to stay informed. But I encourage small doses, and I joke around there, but yeah, the media can be a lot. It can be overwhelming at times. And so we encourage our clients, again, watch the news and read the news to the level that you want to stay informed, and then turn it off, put it away, and go focus on the things that bring you joy. And
Mm.
know that, especially with these financial things or political things that relate to financial things, that we're carrying those worries for our clients. So they don't have to spend too much time there, hopefully.
This is essentially it is for the most part a political issue, it sounds like. Historically speaking, has it made a difference who was in charge of Congress, who the president was? Is there any relationship there?
Yeah, I mean, as far as the debt ceiling goes and these debt and deficit issues, it happens under both parties. There's
Okay.
not, again, it might be, maybe more recently it might be on the GOP side, cutting taxes, or on the other side spending more. Again, both of those things affect the deficits, and both parties have been responsible in ways, on each side. One of the questions, interesting, one of the things that happens, especially from our clients, is we get a lot of questions around like presidential elections and around midterm congressional elections, like, what's going to happen if this president gets elected or that president gets elected? Oh no, there's dire warnings, regardless of, again, what's going on, presidential or congressional. There's concern at times, like what's going to happen if this party's in power or that party's in power. And looking historically doesn't matter, for investments, right? And so we've gone back and look at like regression analysis that looks at different factors and political factors and who's president and what house is controlling Congress. And there's no meaningful evidence that, changes in political leadership are useful in making portfolio decisions. As the founder of Dimensional Funds, David Booth used to like to say, vote with your ballot and not with your life savings. I'll steal that one from him because I like it. I
So
think it's helpful advice.
absolutely. So you would say, broadly speaking, politics don't have a huge effect on the market from long-term
Yeah,
perspective.
I mean, look, government actions can certainly affect market returns, but they're one of so many variables, right?
Mm,
Think about like geopolitical events, inflation, interest rates, technological advancements. All those things affect investment markets. So politics is a small piece of that. And so, again, government decisions, government outcomes can certainly have an effect, either positive or negative, on certain firms. But think about what the stock market is in aggregate. It's all those firms out there that men and women running those firms and the people that are working at those firms. There are opportunities and challenges from hundreds of variables to these firms, every day. Think about Ford, right? Ford they're spending their time trying to figure out how to keep the F-150 being the top selling vehicle in the country. They're
hmm
spending their time trying to figure out, technological advances to power their electric motors. They want to stay the top search engine out there. They want to figure out how to perfect their cloud computing capabilities. They want to continue working on artificial intelligence capabilities. So companies, again, they're going to work hard, they're going to innovate, they're going to grow regardless of what's going on in Washington. And I think that's always an important aside for investors to remember in the day to day when a lot of this, like the debt ceiling, is pervasive across the news.
Ah, that makes sense.
Yeah.
All right, Bart, you really did teach me personally a lot about the debt ceiling. I hope a lot of our viewers take the time to watch this because it's changing my perspective of what I'm seeing on the news and how I'm really interpreting what they're saying because I don't think I understood it as well as I thought I did.
Yeah, and
So
again, it's a confusing space, Richie. It's
yeah,
confusing for all of us. We have to do our homework and figure things out. But it's part of our job here, and we're really big on education as well. So anytime we can be helpful in people, having a better understanding of the how things work and what's meaningful and maybe what's not, that they might be hearing out there or seeing on the news. We hope we're providing a good service there.
absolutely. Oh, Bart, thanks for being on the show, and I'm looking forward to talking to you next time.
All right. Thanks, Richie.